Happy Valentine's Day, everyone. The market's showing us some love the last few days, regaining about half of what it lost over that precipitous decline the last couple of weeks. But again, of course, a lot of that really doesn't matter. Family really takes importance on with the news that we got out of Florida. I'm a parent. I have 4 boys. They all attend school. A lot of you are probably parents too. You know what I'm talking about. I just can't imagine. My heart breaks. For the parents, especially the victims there. So I know a lot of you listen from Florida. Heart goes out. My thoughts and prayers go out. And just, I hope you all feel the love of a lot of parents that are there to support and first responders that were there to help and kind of puts this market stuff into perspective. That being said, let's see if we can't transition and move on and talk about what the market did today. In this bounce, what impacted it, what drove it, and some major relationships that can provide some opportunity going forward. So let's go ahead and get started. Today is February the 14th, 2018. This is the market outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found us for the first time, that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel. Click that red subscribe button right down below the video there. While you're there, click the thumbs up icon right below. You can do that right now while you're watching. That lets me know that you found something valuable out of today's video. And number 2, it lets me know you want us to do it again tomorrow. So one-click way to give us feedback on what you're thinking. Comment on anything that stood out to you today from today's video. You have to scroll down to the bottom of this page even further to do that. And then finally, join my daily email list. I send out daily emails that are related to this video. They're time-stamped hyperlink summaries of everything we talk about. To get that email, you have to join the list. So there's a link in the description I've highlighted down below. Follow me on Twitter for more content in addition to these videos there. Like and retweet today's Market Outlook tweet, always pinned to the top of my timeline. And then finally, join the Market Outlook community on Facebook. You'll see a link at the top, the address at the top of the screen. There's also a link in the description of this YouTube video down below that will take you there as well. All right, let's start off looking at the S&P 500 with the market forecast indicator. You can see we're still trending slowly higher on the intermediate line, which means bullish posture, but weak bullish posture. We talked about this bullish divergence that was setting up on Monday from these lower lows on the index itself, corresponding to higher lows on the blue line here, with the high that corresponds to this peak in between the 2 lows being the target for the divergence. Well, so that was what we talked about on Monday, and Tuesday and now Wednesday we've gotten up to that in just in a couple of days. It brought the near-term line up, and the near-term line now has been above 50 for 3 days, all 3 days this week. 7 to 10 is a normal range, but again, we're at the beginning of a bullish rally. You can see over here, this one, obviously not the same in terms of how big it was, because pullback wasn't nearly as big. But you can see the near-term rally lasted over here 1, 2, 3, got up in the reversal zone, 3, 4, 5, 6, 5 days. So we had 5 days up above before that near-term pullback. That then was the bounce that started, that kept that trend going. In the meantime, the market sentiment line intermediate line got above 50 during that first near-term rally, but it wasn't it was this rally now that was 7 to 10 days, and then that one that was more than 7 to 10 days, and another one, and then you can see how, and then they started to get more volatile. We should have probably ended the rally there, but again, the beginning of the year pushed us up to crazy new high after getting a bunch of ovals. We went 4 weeks without one, as we just went up every single day in January, and of course that precipitated this. So that's we're back here. We're at the beginning of what could be an intermediate run, but don't expect this near-term rally to last. That's typical 7 to 10 days. Probably more towards 5, 6, 4, 5, 6, maybe 7 or 8 in that time frame, but kind of more toward, obviously more than just 1 or 2 because we're already at 3, but not that typical time frame that we saw all throughout that rally. So that's kind of what I'm looking at. So and this resistance that we're at, and that's that's what I tweeted out here today. This resistance here at that 38% Fibonacci retracement. So we've pulled back into this retracement muck. Is how I refer to it. I misspelled it, but that's how I refer to it. We got to the 62% Fibonacci on a closing basis. Have been back up above it, trading all within it now. And again, this Fibonacci retracement line is based on the last intermediate low point. There's our last intermediate low point that we've had. We've had this 5-month rally with the near intermediate line being above 50 this whole time. We're obviously forming a new intermediate low point right now that's higher than the last one, as deep as it was. But we're kind of stuck in this Fibonacci retracement muck, and we're peaking at that resistance level there, right about 2,700, the top end of that. The 38% Fibonacci retracement. Really quick reminder again, if you follow me on Twitter, like and retweet the Market Outlook tweet. Always pinned to the very top of my timeline. We got to 137. Our record's 142. The goal is to get above 150. So if you're watching, like and retweet. That makes sure that Twitter will, knows that you want to see my tweets. It also helps me in getting these tweets out to everybody who follows me because of how much engagement it gets. So I appreciate the likes and retweets. Keep them coming. Let's see if we can get above 150 there. All right, going back to the market forecast here. So we got that same thing as we had back here. The near-term line got into the reversal zone, upper reversal zone coming up off the low. Same thing here, got in the reversal zone coming up off the low. That's a good positive sign for a bullish trend. Again, and we could keep going up because January, that's all I got to say about that, right? So we can keep going up, but the expectation is resistance will hold until it doesn't. And if you can't really see it as much here, but you can see it a little bit better there. There's a high right here, so you expect that resistance to hold. In this case, it's not very strong, but it's a short-term resistance. You can see there's some other congestion in this area back here. It's a big round number, 2,700. So we expect that to hold until it doesn't. And even on the short-term basis, if it were to hold and pull back here, then you see the developments of a inverse head and shoulder pattern, and that's kind of the expectation there, especially with the near-term line overbought so quickly coming up off of a weak bullish posture. Market sentiment's dropping just like it was dropping back here. We're setting up for a dip. Again, it would be a higher dip, and you can see the dips have been getting higher and higher. Now that dip didn't lead to much of a run. It was only about 1 month. That dip led to a crazy 5-month move, but it should have only been 1 or 2. I think, based on what we're seeing here, and knowing, tax reform started right about there, the expectations, it got passed in here and then took off once the year started. So that right about here is probably where this intermediate run should have ended. That would have been a really good one because we were only expecting 1 to 2 months, but that's where it probably should have ended. We should have pulled back into this area, formed a new low point, and healthily, if that's a word, bounced up to new highs and higher highs, higher lows, all that. Nice, good, solid trend. This was too much. It was too much of a move, too fast. And so it's going to be hard to get back onto that healthy trend because of how volatile things are. So expect some ups and downs. We've had a big down. We've had a nice good up here. Back up to about, let me see, what was that? What would that be? Let's get rid of that retracement. So here is the Fibonacci retracement of this intermediate bearish move. So you can see we're right back up to the 50% Fibonacci retracement. So another area of resistance holding that in that area. So expect a pull back down. How far back down could it go? That's where I had those Fibonacci retracements. Probably down to right about 26.25 area. In that area, you pull back down into that area, maybe 26.50, right around where that 38% is. Bounce off of that, and then we have a better near-term point for this intermediate trend. Obviously, it'd be a higher near-term low, but it would give us a good opportunity for a bounce heading up higher. Take a quick look at the other indexes here. We'll look at the Dow Jones Industrial Average. You can see very similar pattern. Posture is turning bullish there. Near-term lines overbought, a good sign there. It's good to get the near-term line in the upper reversal zone. Same divergence, same target, same thing for the NASDAQ. Exact same pattern, weak bullish posture, and then finally the Russell 2000. Also had a good day today. Pushed up higher than that target, but still from a market forecast standpoint, very similar pattern we're seeing there as well. You can see on the long-term chart that we're trading inside the candle range, so a little bit of a Harami pattern. We still got 2 more days left, of course, but got a little bit of a Harami pattern forming here. Obviously, a bullish reversal pattern. We talked about, when you get stuck in between the averages, now you start to get a lot of arrows between the 50 and the 200. And when you test that 200, you're in between. You'll get some arrows. The next one's going to be green, which means we'll get above that 50 at some point. Doesn't have to be tomorrow. Doesn't have to be this week. It could be next week or the week after. But we're going to kind of trade in this range. We've got a big gap here. But eventually, based on what we've seen in the past, we expect it to go up. Back up above the 50. Again, maybe not the new highs. This year's, there's still expectations for a good year, and we're just barely, we closed 2617 at 2673, so we're only up 25 points now. And most of that coming today, right? Because we were down 10 points heading into today for the S&P. So we're up on the year again. And I've shown you before that line of where if we were to get a 20% return, which is average for a year where we are up so much in January, then we're just basically getting back on that trend line again. I believe I showed that to you in Monday's video. Looking at the three green arrow chart, you can see again we're getting back to the stochastics above its moving average. It's formed a green arrow. The MACD hasn't formed a green arrow yet. It's not above its moving average. That's when you get a green arrow on the histogram. Of course, it's still well below its moving average and well below 0. And let me just remind you here, when we get this far below on the net, we had never been that bullish on the upside, but we have been this bearish before, so this is nothing new. Again, it's not as bearish as these numbers because the number is higher, so keep that in mind. But when we have been this bearish, look to see how we get right up to very strong levels, right about 25 points every other time. So in this case it took a while because we were in a bear market there, but these others where we were more bullish, you can see we went from extreme low to bullish high, and I shared those numbers in a tweet before, all about 13% average return in about 70 days from those lows. So that's with ups and downs in the middle, especially in those first few weeks. We've had our ups. Again, look for that right shoulder to form here on that, with these areas here showing where support could be on that potential inverted head and shoulders pattern. Bullish candle today with a higher high and a higher low. The high we closed above yesterday's high point. Yesterday's range kind of stayed inside the previous day's range, but we broke out of that today. We're also into the upper half of the week's range, of last week's range. So it's not as bullish as we could be, because there's going to be some resistance in this area, but better than as bearish as we were, right? And then of course a couple more days we'll move last week's range to this week's range, and as long as we stay in the upper half, we're good. And if you look at the 4-week range, again, we're not moving it anytime soon. We still got a few days left to go before we start moving this one down. But you can see we're kind of approaching the midpoint of this 4-week range, which again will act as another layer of resistance there, at least on a short-term basis. So when you look at the daily chart, you can see the range today was 5.7 points, so a bigger range, a little bit of a breakout, and that's why we got that range. 120 million shares traded, so more than what we saw yesterday when volume really came down. So 120 is, but still below average. Because that average is really, really high right now. And the average is about 4 3/4 points. We had a 5 3/4 point range. So we're not going to keep getting those kind of ranges. If we do, it's going to be more bearish. So we'll kind of keep our eyes on how big the ranges are and the volume levels. But remember, these are at high levels. And once they start rolling over, as we've seen previously, that will typically lead to bullish moves to the upside, to a smaller and smaller degree. The candles will start to get smaller, the moves start to get smaller. But you can see how we get up to these high levels. We hold for a little bit of time. We might hold for a little bit of time as we kind of muck around. But then they'll start to grind their way back down, and that usually leads to big upward moves there. And finally, take a look at the volatility. Back below 20. I don't think we'll get back below 10. Right? I think volatility has now changed, especially if some of these allegations of VIX manipulation are true. You're probably not going to get below 10 anytime soon. We'll probably get down more towards from a new low point, at least down to 15, where these old highs were. So we'll kind of keep our eyes on that. But again, near term, if we are hitting near term resistance and we start to pull back, then you'll see volatility start to pull back up, potentially now back up to this 25 level. Again, we talked about before getting back up in the 30s. We did that. Now we're dropping back down to 20s. We went through those short-term lows here at 22.5. So look for it to bounce back up, and if we are to pull back in the short term, bounce back up to this 22.5, 25 where the gap is. We'll fill in that level, hit some resistance, and potentially roll down from a lower high on volatility. That's on an absolute basis. One positive thing on the relative basis is we're back down to 1, right? Because you remember, 90 to 95 is neutral. You get above 90, that 95% range. Now you start to be overbought, of course. Getting above 1, you're overbought on volatility. Getting above that, 110 level is extremely high. Same thing on the downside. 85 is, this 1 level is kind of like the sweet spot for bearishness. So just like 85% is a sweet spot for bullishness, and then getting above 110 is getting above 110 is extreme, and getting below 80 is extreme. 80 and 75 is really extreme to the downside. So we are kind of at that. So we're in the bearish mode. We're above the neutral zone. We're in bearish mode right now, and we're pulling back to that sweet spot. Where in the past, when we've hit the sweet spot coming up, that's been a little resistance level. We've pulled back down and volatility has dropped again. So we'll see if volatility doesn't bounce back up. Again, I don't expect it to bounce back up to 1.3 or 1.4, but again, bouncing back up towards that extreme 1.1 level, and then we'll know, okay, we've pulled back enough in the short term to form that inverted head and shoulders and bounce back up off of a new potentially higher bullish near-term low. Now that would be typical, and of course markets do not always behave as expected. We can go up every single day for that matter. We can drop all the way back down to last week's lows and really drop depending upon news announcements. But from just a technical level, looking at the charts, seeing what we've seen before, that's kind of a summation of the technical expectations that we look for the S&P 500 to do in the next few days to a week. All right, now let's talk about what's driving the price action today, and we can take a look at the calendar here really quick. And the main thing that came out this morning, there was a few things that came out, but the main thing that really drove stocks early in the morning was CPI. In fact, if we take a look, go back to this chart, you can see we actually gapped down. But if you were to take a look at the futures market here for the S&P 500 and look at the intraday chart, let's go back a little bit. You can see there's where, that's at 6:30 Eastern. That's when the CPI numbers came out, and stocks really fell sharply. I mean, the futures lost how many points here? From 2675 down to, in a matter of 5 minutes, down to 2633. So we lost 40 points. That we started to recover by the time the market opened, so we were only down 30 points from that, and then by the first hour of trading, we had completely recovered it. Hit it for resistance, right? So we filled that in, hit it for resistance, and then finally broke through and had a decent run into the afternoon. So you can see pulling back just a little bit in the after hours on no volume, hardly whatsoever. So that's what drove. I mean, that was the biggest thing today, is that CPI data, and let's take a look at it here. You can see it was much more than expected on a month-over-month basis. That was last quarters, and then this is the expectations. The year-over-year on a headline basis met last month's year-over-year figure, a little bit more than expected. And then again, the core level creeping up above expectations, but not above. So So the expectations were that we'd pull back a little bit on inflation on a year-over-year level, and we didn't. Right? We actually beat expectations and went higher than last month, and so on a year-over-year level, maintain the same pace. There's your year-over-year core and CPI data. So still right around that 2% level on a headline basis, growing on the core level, getting back up there. And you can see the impact it had on the economic surprise index, still right about 40%. So we're still pulling back from 80, being above 80, but also still at levels that were previously very, very high. Now the CPI, and we also had other things come out that don't get a whole lot of play. Business inventories, and you can see that's green. Retail sales came out. That was an impact. You can see the year-over-year levels falling pretty sharply. A lot of that has to do with these rising mortgage rates, which are impacting mortgage applications. So borrowing costs are going up with these yields. Yields, you can see the 10-year note. If I were to take a look at that, with this higher inflation figure, it really pushed yields up. We started the day down 2.81%, finished the day at 2.91%. So 10 basis points in one day, quite the move. And then again, looking at it on a long-term basis here, how far away, you can see how far away we are up above that 200-day moving average. In fact, if I were to change that MACD down there to see how far, right now it's measuring the gap between the 50 and 200-day moving averages. If I measure the gap between the yield and the 200-day moving average, we've been 5 points up above it before, 500 basis points. Back here in 2016, we really sharply got off of it and diverged a little bit and then pulled back. You can see back in 2013, we got above it, formed a divergence, big-time divergence, before pulling back and getting way below it. So let's go back even a little further. You can see back here in 2011, we got 500 basis points up above the 200-day moving average, and then formed a little bit of a head and shoulders pattern. It came back down and really fell from 3.5%. That was early 2011. And you can see in 2009, coming off a sharp low point, we got 500 basis points up above it. Now remember, 500 basis points up above it at 3.75% versus less than 3 is a bigger number, right? So that's pretty high, relatively speaking, compared to where we're at there. Not as high as it was this one. That was a little bit higher because that's the lowest point. We were at 2.5%. So needless to say, these are all relatively about the same levels considering where the yield was at the time. And we've seen in the past that it's hard for the yields to maintain themselves at that pace. Now, we can get a little bit higher, and that's why I think we could get up to 3%. There's some obvious resistance there. There's going to be a lot of people expecting it to pull back at 3%, and myself included. And there's going to be an obvious level of where it can pull back to. It will be to that 2.6% level. If I were to get rid of that Fibonacci retracement and then draw this one, and then draw it all the way up to the 3% area, you can see your 2.6% retracement level is going to be right about the 38% fib level. So, if we continue a little bit higher here, look for that pullback eventually to get to that level. And you can see those higher expectations that's led to GDP estimates, which are also affected by the inventory data and the retail sales, pulled back down to 3.2%, still relatively strong number. But this is what I want to look at. The odds of a rate hike in March are still high, right? We're still looking for a rate hike in March. And this would be 150, 175. There's the odds of not having a rate hike at all, just barely over 22%. If I take a look at June, which would be the next meeting where you'd expect a move, the odds of a rate hike for June were pulling back. But we bounced today with the CPI data. We take a look at September, which is where the third one could be, and that one we're looking at would be the 200 to 225. You can see how that ramped up with the higher inflation data. There is only having two, between March, June, and September, having only two stayed at the same levels. Having only one among all three meetings, pulled back down sharply. So, the odds are rising that we'll continue to get more rate hikes throughout the year with the strong inflation data. So 225, 250 would be the next one, and you can see it's the one that rallied there, as well as did the 3 rate hikes, whereas 2 and 1 both pulled back. So the odds of getting 3, the odds of getting 4 pulled up today, 2, 3, and 4. The odds of only getting 1 or maybe 2 by the end of the year went down, and a lot of that had to do with what's happening with inflation expectations. And you can see that after the inflation data came out, and what happened? Well, gold rallied. The dollar fell, bonds fell with yields rising. The gold rallied with the weakness in the dollar. Emerging markets rallied with the weakness in the dollar. Stocks rallied all across the board. And you can see crude oil, which was down early and led to a lot of that weakness, it rallied today again with the weakness in the dollar. So very weak dollar influence move. And again, going back to the chart of the U.S. dollar here, and we'll go to a longer time frame. We talked about how we've been on this bearish trend. This was a short-term bounce. Well, it was a short-term bounce. In today's move, you can see pulling back down, even with the high inflation levels, pulling back down. And if I were to go out a little bit further, I have to go even further than this. Let's go back out to, nope. Let's go further. We can pull down. So here's 90 right here. See these old highs back in 2009, 2010. When the market was, using the dollar for a safe haven. So there's some support from that area. But, the dollar was even weaker after that, right? The dollar got weaker in 2011. During all that QE, the dollar was weaker there. And eventually, by the time we got to the summer of 2014 is when things took off. We've got some room for it to drop and continue to trend lower. And if I were to take a look at the 50 and 200-day moving averages, we've got a strong bearish trend right now on the dollar. We got back up to the 50-day moving average, and now we're continuing to follow that trend lower, and we see the impact of a weak dollar across the different asset classes. Now, that won't always be the case, right? Because eventually these high yields will lead to people wanting to buy treasuries and take advantage of that high yield. But until then, as yields are rising, as bonds are falling, we've seen the relationship to be the dollar falling along with it. So we'll know how to take advantage of that. From a sector rotation standpoint, everything rallied today. And you can see pretty much all the assets except for your safe havens. Staples lagged, and utilities and real estate fell. So it's been, those are typically your dividend, yielders, and they struggle in an environment where treasury yields are rising so significant. You can see just for the week that, really coming off of this low point here, it's been a technology and consumer discretionary led bullish move. A lot of other things kind of matching the market, energy catching back up, all these other areas matching the market. Your safe haven still with a gain off of that low, just not as, basically half the gain of what a lot of these other sectors are providing. With today's trade example, we'll revisit a trade we did last week. We look at this. We did a bearish vertical on Freeport-McMoRan last week, getting up today, really benefiting from the rise in gold, the drop in the dollar, and the higher inflation data, right? So that's what impacted this. We have 1.5 times the average volume, practically 3 green arrows with the MACD and the stochastics here, kind of all moving higher. And you can see I have the 2-line versions to kind of give you an idea that MACD is coming up now above its moving average, just barely, but still below 0. Stochastics moving up above its moving average, also just still below 50. So they're still relatively weak. We got up to that 19 level. That was a resistance we talked about before, a little bit above that, but again, support and resistance isn't exact. It's not precise. It's more of a range. So we're still kind of in that resistance range, but that's a pretty decent move. Typically, 3 green arrows spike in volume, 1.5 times average volume is a buy signal. And, again, this particular stock has been lagging behind the market here. In fact, you can see if I were to take a look at this long-term chart, go back to this long-term chart, and we'll take a look. We were taking advantage of the fact that it was lagging behind. That's why we were looking at the bearish trade. but now looks like bouncing off of what is a 50-day moving average with potential to start to outperform again. And we would expect it to outperform if the dollar continues to be weak. If the dollar continues to trend lower, commodity prices will continue to push higher. Just the anticipated, bounce in the dollar that would put some weakness on this sure didn't last that long. So we have the opportunity now to say, okay, things have changed, right? We got that nice, good bullish signal. Now it could pull back tomorrow, and we might be able to get, a better price. Right now, this was sold for 39 cents originally, and I believe it's 66 cents now to buy back. And, that would be if we were to do that, that would be a roughly $36 loss per contract or per vertical spread if we were to close that back out. And that's the point. Remember, the point is to keep our losses small, especially relative to what we're trying to get. It's hard to overcome a $161 loss. Much easier to overcome a $36 loss relative to the maximum gain on that at 39, which we need, which we get if we stay below 19. We're almost there, but from a technical perspective, the 3 green arrows and the spike in volume suggests, and the trend down in the dollar suggests things can go up. So from that perspective, we might say, okay, well, tomorrow here, let me pull back out to a little bit longer time frame. Tomorrow, if we pull back down to 18.5, then I can maybe get out of this at a $30 loss or a $28 loss. Again, the point is to keep the loss smaller, but now transitioning again to a more of a bullish trade, because this thing, from a long-term perspective, we saw that it was hitting, relative to the S&P, it was hitting the 50-day moving average. Well, so was the stock itself. We pulled back. It got below the 50, and now bouncing back up above this with 3 green arrows. There's opportunity for this to trend higher again. There's the last time the dollar hit, we'll be looking at the dollar here. The last time the dollar hit 80, which if we break this 90 level, that's where we'd start looking. There might be some resistance here at 84, but that last major resistance level, or support level, will be down at 80. Well, the last time that did that, Freeport-McMoRan was double where we're at right now. So there's a pretty decent move for this, even if the dollar falls just to 84. So we can say, okay, well, I know a lot of you have been talking about, can you talk about buying stock opportunity? There's an opportunity to buy the stock, $19. One thing to keep in mind when you buy the stock right now at this level is, we teach you to put your stop orders below support. Well, there's your support level, the low point that preceded the 3 green arrows. So you'd have to put your stop order below 17-ish, 3%, a couple ATRs below 17. Considering that we're already at 19, that will be a pretty large trade risk. And when you have a large trade, no matter what your portfolio risk is, which is how much the portfolio risk is, how much you're willing to lose total on this trade, right? Your trade risk is how much you're willing to lose if you only own one share. How much per share are you willing to lose? And so no matter how big your portfolio risk is, because that's dictated by what you decide it will be. Your trade risk is not dictated by what you decide it will be. It's dictated by where support is and how far up above support you are. The further above support you are, the bigger your trade risk is going to be. And when you take your portfolio risk and you divide it by your trade risk to determine how many shares to buy, the bigger the denominator, the fewer number of shares you're going to buy. So you're just not going to buy very many shares right now. You can eventually add to your position on a new set of 3 green arrows in the future, but right now you'll start off with a smaller position, simply again because of how large your trade risk is, and that is dictated again simply because of how far up above support we already are, because of how big today's move was. And it was that big move that's kind of nullifying that bearish vertical spread that we did. So the alternative to that is, looking at a long-term option trade, looking at an at-the-money long-term option trade. Instead of spending $19 a share, we're only spending $2.89 a share. Instead of having a trade risk of, roughly about what would have been, if we put a 3% below 17, or even just an ATR below 17. Let's take a look at what that would be here. The ATR right now is 0.86, so we're looking at about 3.5 points for 2 ATRs. No, excuse me, 1.5 points roughly, maybe 1.75. So we're looking at a stop order at probably 16.5. If you go below 7, and again, I'm just using ranges here. So support at 17, 2 ATRs would put us maybe down to 16.25. Let's do that. 16.25. That's almost a 3-point move. Whereas if you put your stop order at 50% of 289, that's, let's see, let's do it this way. Do a buy custom with stop order. A stop order 289. You're looking at $1.45 roughly of a stop order. So let's see, how far down, from a theoretical standpoint, would the stock have to get? Well, let's look at it this way. Let's analyze that trade. We already had it in there, so we'll take off the vertical spread. There's where we're at right now, so we will reset the parameters here. And then so here's where we're at right now. So if we were to continue down, the purple number over here tells me where my loss is going to be. Right now, for me to lose $145 on this, we'd have to get roughly about to right there, to 16.25. But now instead of spending, 100 shares would be, $1,900, I'm only spending $289 to get into the trade, with roughly about where my same spot where my stop order would be, regardless whether I had a 50% stop order on the option or 3% below support. So I'm getting more bang for my buck. See, if I bought 100 shares, I have to spend here. Let's do that. 100 shares, and we'll add that in. Analyze that trade. So if I bought 100 shares and we went up $1, then I'm going to make $100. $100 on roughly 1,000. Well, that's if I bought it on margin. $100 if I didn't buy it on margin, almost $2,000. Whereas if the stock went up $1 with this option, then I'm going to make $50, so half, but $50 on 289, which is a much bigger percentage move than $100 is on 2,000, with my stop order in the same place, with the opportunity to lose, my portfolio risk in either scenario. Whichever it is, either scenario I'll lose what I dictate my portfolio risk to be. So with that being said, thank you very much for watching tonight. I hope you, again, as always, you get a lot out of it. Again, hearts on a day like today go out to parents, families, kids in Florida and anyone in that area. What's going on there? Just, again, words just can't express. Words just cannot express, how you would feel in a situation like that. So hearts and prayers and thoughts go out to anyone over there. I know we have a lot of listeners in Florida. Everyone else, again, thanks as always for watching. Stay tuned. We'll break this market down day by day. We'll see what our expectations are, see if anything changes to those expectations based on what happens tomorrow and the next day. So stay tuned for Brandon tomorrow night. I'll be back on with you on Friday. Have a great one, everybody, and we'll see you next time.